Most people don't realize, but many businesses can save tax by being on the right VAT scheme. One of the main schemes we recommend to our clients is the flat rate scheme. And in a lot of cases, our clients have saved thousands of pounds just by using this. So I'm going to take you through what the flat rate scheme is, how to calculate if it's right for your business, and when you should come off it. Now, if you want to see more content like this, don't forget to click the subscribe button below. So what is the flat rate scheme? The flat rate scheme was designed to simplify VAT for small businesses, but we actually use it for tax efficiency. So you still charge VAT at the standard rate, but you then pay HMRC at a lower fixed rate. You don't reclaim VAT on most purchases. There are some exceptions, and we'll go through that later. And it's generally good for businesses with low VATable expenses. So, how does the flat rate scheme actually work? So, you still charge customers 20% VAT, but you then pay a set percentage of your gross turnover, inclusive of VAT, to HMRC. And any sales which you send from the UK, maybe to the EU or the US, they'll also have the flat rate applied. And it'll also apply to zero rated exempt sales, even if that VAT rate is 0%. The rate which you actually pay HMRC depends on your business type. And for our e-commerce clients, that is 7.5%. And there's no need to track VAT on most purchases, and it really simplifies bookkeeping. There is a bonus that you'll get a 1% discount for the first year of joining the scheme, which really makes this attractive. So let's look at the HMRC flat rate percentages. To find the rate which applies to your business, you need to go to HMRC and they provide a list of percentages on each business type. For example, e-commerce is 7.5%, while an advertising agency is actually 11%. And this is because HMRC have calculated these rates to reflect the typical VAT costs for each sector. So when you go through this list, you want to make sure you choose the right one for your business. So when is the flat rate scheme good for your business? The main reason is going to be financial. So if you don't have many VATable expenses, then you can save money by joining the flat rate scheme. This is great for e-commerce sellers who are not paying VAT on ad spend or their products, and you'll be able to easily calculate this to determine if the flat rate is right for you. So we have an e-commerce seller who has hit the threshold of £90,000, and he has a choice between the flat rate scheme or the standard scheme. So we need to calculate which VAT scheme is going to be best for him. And the first thing we need to do is calculate what is his margin now. So we know his sales price is £100 and his product cost is £30. He's got advertising costs of £40, which leaves him a profit of £30, which is a 30% margin. Now we need to calculate what he would pay in the normal scheme. And remember, he needs to take 20% off his sale price, but also any products which have got VAT on as well. So for his sales price after VAT, it's £83.33. His product cost is now £25 because he can reclaim that £5. He then has advertising costs still at 40 because that they don't charge VAT, which means his profit margin is now £18.33, which gives him a margin of 22%. So if he was flat rate scheme, he'd need to take off 6.5% from his sale price, but he can't reclaim any VAT on anything else. So in this case, his sales price will be £93.50. His product cost will still be £30. His advertising cost will still be £40, but that now leaves him a margin of £23.50, which is actually 25%. Therefore, each time he sells an item, he's saving £5 roughly by using the flat rate scheme. And that means if he sold 1,000 items, he'd be saving £5,000. So in this case, the flat rate scheme is very much best for him. So when will the flat rate scheme not work for your business? So the flat rate is bad if nearly all of your purchases have VAT on. And if they do, you're likely to be paying more in VAT under the flat rate scheme than you would under the normal scheme. So let's go through another example. And we've got an Amazon seller who's selling items for £50 on Amazon. He has cost of £20, which includes VAT, but he's also got Amazon fees of £18, which now include VAT as of last year. So let's calculate which scheme would be better for him. So we've got sales price here before he was VAT registered of £50. His product cost was £20. His Amazon fees were £18, and that means his profit was £12, which was a 24% margin. Now, under the normal scheme, he's going to be reclaiming the VAT, but also losing 20% from his sales. So his new sales price will be £41.67. His product cost will be £16.67. And then his Amazon fees will now be £15. This gives him a profit of £10, which means he gets a 24% margin. So this is basically the same margin as if he was not VAT registered, but he's making slightly less per item just because of the impact of VAT. So let's look at flat rate. And again, he can't reclaim any costs here. So his sales price will be £46.75. He can't reclaim anything, so it's £20 for the product costs, £18 for the Amazon fees, and this leaves him with a profit of £8.75 and an overall margin of 18.7%. And in this case here, we can see that by being on the flat rate, it's actually less of a margin than the normal scheme, so it means the flat rate's not best for everyone. So in this case, if he sold 1,000 units, he would save around 1,250 just by being on the normal scheme. So if you've calculated that the flat rate scheme is for you, you need to make sure you meet certain criteria. So turnover must be less than 150k or less, and you can't join if you've already got a business which is already VAT registered and it's closely associated. You must leave the scheme if your turnover goes above 230k. However, this is calculated on the anniversary of the VAT registration date. So you may be selling well above 230k until you actually need to come off the scheme. Also, non-residents can't apply for the flat rate scheme. What are the common mistakes and pitfalls to avoid? So choosing the wrong business category at the start means you could either overpay VAT or HMRC could come after you and say, look, you should have paid a different rate, please pay the difference. And then some people forget that they need to apply the flat rate scheme to zero rated and exempt sales. Even if they're in a normal scheme, they'd charge 0%, you need to make sure you're charging the flat rate on those items. Others forget to apply the first year discount of 1%, which can cost you thousands of pounds. And one thing we see a lot is people trying to reclaim VAT incorrectly. One example here is that people try and use the postponed VAT scheme, but you can't use that when you're on the flat rate scheme. The main one is stay on the scheme when it's no longer financially beneficial to do so. So maybe your advertising costs have dropped or your supplier is now VAT registered. You will need to redo your calculation to determine if it's still the right scheme for you. The last one is critical. If you do the comparison between the normal VAT scheme and the flat rate scheme, but when you calculate it on the normal scheme, you're not making any margin, but you are on the flat rate scheme, you want to consider if this business is something you want to continue or if you need to change the model. Because eventually you'll come off the flat rate scheme when you hit 230k. And if you're not profitable in the normal scheme, then it's probably not a good business model. To register for the flat rate scheme, what you need to do is when you first apply for VAT, you need to make sure you tick the box which says apply for the flat rate scheme. Or if you've already got a VAT number, you need to send a separate application form to say you want to join the flat rate scheme, and HMRC will confirm this. When you're doing these applications, make sure to choose the right business category and the right registration date. So if you're registering at the same time as you register for VAT, this needs to be the same date as your VAT registration date. And then there's one question I get asked all the time is that, can I actually reclaim anything on the flat rate scheme? And generally you can't reclaim anything on purchases. However, there is an exception. You can reclaim VAT on capital assets over £2,000 as long as they are on a single invoice. That item must still be used in your business and you can't reclaim on services or multiple items that add up to £2,000. So when do you know when you need to change schemes? So you should consider leaving the flat rate scheme when your VATable expenses increase. So maybe your supplier has registered with VAT now, or you've started making a lot of zero rated or exempt sales. In this case, you want to voluntarily leave the scheme and you can do that at any point. And then you must leave the scheme once you breach the 230k threshold on the anniversary of your VAT registration date. So when should you consider moving to the flat rate scheme? If you have low VATable costs, maybe you've got new suppliers who do not charge VAT, or you're spending a lot more on Google Ads, then you'd need to do your calculation again, compare the schemes, and if it turns out you get a higher margin on the flat rate scheme, you should register as long as you're below 150k turnover. To make this easier, we've created a quick template to compare the flat rate scheme with the normal scheme. So all you need to do is input your figures and your VAT status. You can then calculate which scheme is going to be right for you. So you can find this template in the notes below. So give that a download and make sure you use that before you register VAT. So I hope I've given you some clarity on the flat rate scheme. So make sure to like and subscribe and find out how we can get more profit out of your business.